I don't think anybody just says, "Hey, I want to be in the mortgage business," or "Hey, I want to be a realtor," or whatever. But yeah, so I actually started off when I got out of college. I was a teacher and coach. Then eventually, it's just one of those things. You're working a ton of hours, and I'm making a lot of money. It's like, what can I do to just make more money, right? So I ended up in insurance. Well, insurance led me to mortgage. So it was one of those things that I just fell into.
Hey, it's Tim Miller. After spending 2 decades as a photojournalist in the Navy Reserve, capturing and sharing incredible stories, I've harnessed my passion for storytelling for something truly cool. Join us as we interview amazing entrepreneurs, including veterans, while sharing captivating stories and having a great time along the way.
Okay, so Tim, I'm hearing a lot of fear over interest rates with people getting ready to buy homes, or even buying a home in the forefront of their future. What's the story behind interest rates right now?
Yeah, actually, interest rates, right? Everybody's comparing interest rates to what they were, 2 years ago, right? 3 years ago when they were in the threes. So once they spike up like they did last summer, definitely there is that fear. People want to stay on the sidelines and, not move forward. So rates right now, you're looking at, normal rates somewhere in the sixes, right? So that's causing a lot of people, for one, there's not a lot of inventory, right, for people to go buy a home, right? Because people that have all the 3% interest rates, they're not wanting to sell those and, move into a higher interest rate. And then those others that are seeing a higher interest rate, they're just kind of scared to jump in and do something. But what we're also seeing is by those higher interest rates, a lot of the competition has now gone away. So
right.
Before with those lower interest rates, you have, people coming in offering, $20, $30, $40, $50,000 over asking price. So you have a lot of first-time home buyers.
It's crazy.
That can't compete with that, right? So once the rates went up, we actually started seeing some of those actually start finding homes, and you start seeing seller credits, right? So helping with that down payment, where a seller is not, getting over asking price, but they're actually giving money back to help with that down payment. So even though the rates are actually higher, it's actually easier to get into a home, because what's going to happen is these rates begin to start going down throughout hopefully starting in the summer, that competition is going to start coming back.
Gotcha. What does 1% equate to in the big picture, like an average? I'm just curious.
1% as far as like a payment, or whatever.
Yeah.
It's far, you can say right now. So let's say if it's 6%, you can say that about every $1,000 financed over a 30-year mortgage is about $6 per thousand.
Gotcha.
So 10,000, about $60 per thousand. If it was 5%, it would be somewhere in the, like $5 per.
Gotcha.
Per thousand.
Tell me about the market right now in the big picture. I've always heard, hey, if you're concerned, just wait 3 years with respect to real estate. Is that still?
Well, no, I wouldn't wait, because what's been happening is you start seeing these values go up, right? So every year, the home values are increasing. So right now, as you're sitting on the sidelines waiting to buy that home, say, $300,000, $350,000, right now, as rates go down and more buyers come in, that $350,000 house is now, $375,000, $380,000. So yeah, you just save a little bit on interest rate, but you paid more for the house.
Gotcha.
So you can always refinance at that higher rate. So you bought the house cheaper. So right now, we're definitely saying now's a good time to buy.
Okay, let's talk about down payments. Some loans you don't have to have a down payment. Yeah. So like a VA loan, there's USDA loan. Yeah, there's different type of loans that don't require a down payment. Mm-hmm.
But one of the biggest misconceptions that we get is people think they still have to put 20% down to get into a home, when that's not accurate. So to say you're a first-time home buyer, we can get you into what's called a conventional loan at 3% down. We have FHA 3.5% down.
Wow.
If you're not a first-time home buyer, it's 5% down. So there's different options. And then we can look at, if you're a veteran, VA loans, 100% financing. Being in the rural area, which a lot of our stuff, is, we have more, kind of Wise County, Parker County. You have USDA loans that's 100% financing also. So we're actually getting people into homes right now, not coming really out of pocket, other than because a lot of times they're getting seller credits back as well.
So here's a wacky question. Can you tell me the difference between the FHA loan, a VA loan, and a USDA loan? I've never heard of a USDA loan.
Yeah, so all three of those loans are government-backed loans. So those are considered our government loans, right? So an FHA loan the benefits of that is really, people think, especially first-time home buyers, they hear and they've heard over years, I have to have an FHA loan. So when I get people that call me, a lot of times those first-time home buyers are saying, I need an FHA loan. Well, we just get their information, take it in, we put them through the best program. But an FHA loan, a lot of times that's for people with maybe a lower credit score. We can go down to like a 580 credit score on those. It also helps, limits your down payment a little bit. We have debt to income ratio. We can go higher on those. So, those help with those first time home buyers a lot, or people that have credit issues. A VA loan, of course, those are for our veterans.
Gotcha.
That, serving, we can do a VA loan. Those are 100% financing.
Gotcha.
And then a USDA loan, those are rural areas. So, people, like I was saying, people that we're out here kind of in our area, most of Wise County and surrounding areas, we qualify for the USDA financing.
Okay. Can we talk about credit a little bit? That is obviously, that affects everything.
Right.
And I think moving into the future, that's going to be more and more important for people to kind of take care of their credit. Like what's a good credit score? Do they need to have a 700 to get a house?
Right. Yeah, and that's another one of those misconceptions, right? Is I have to have a 700 plus credit score to be able to qualify, when that's not true. We can go, like I said, we can go all the way down to 580. Some programs, it's a minimum of 620. So, you don't have to have perfect credit. And one of the things that we do also, and we get a lot of people that come in that, their credit is too low. We work with them, put them in a credit plan to get that credit score up. Because a lot of times there's very minimal things that you can do to go ahead and get that score up quickly. So we can go ahead and put that right back in. We can get those scores up sometimes within a week, doing minimal things. You have to bump it up, 15, 20 points,
right,
like that. So there's things that we do to work with them to get those scores up. But yeah, you definitely don't have to have a 700 credit score. The only thing that's going to do, because there's two things that affect your interest rate when we're looking at that, and that's going to be the loan to value. So how much money do you put down off that purchase price, and that credit score. So it's a combination between those two that's going to affect what interest rate you get.
Gotcha. Okay. Very cool. So a week is crazy. That's doing some major.
Yeah. Sometimes those are minimal things. Maybe they have to pay off. You have multiple credit cards. That revolving credit line can really affect your credit score. Some people have maxed out credit cards. But you can come in, pay those down a little bit, and that can bump your score up.
I see.
Very quickly. So usually that's one of the most common things.
I see.
To bump those up.
Well, and actually that leads me to my other question with respect to credit in general. But how can people, when I start looking for a home, let's just say I'm a year from now, I'm going to buy a home. What do I need to be doing to increase my credit score? Just the basics.
Yeah. Well, first that kind of leads into when people start thinking that they want to buy a home, that's the time to contact us, and where we can start working on that pre-approval, right? Because people think they have to get that credit, that credit score up. They think they're in it by themselves. But if you go and come to us, it doesn't cost anything, right? And it doesn't take long at all. We work these pre-approvals up within 24 hours and back out to you, a lot of times in the same day, and it would get you on a plan to work,
right?
To work with you to get you there. So those are just things, there's certain things you can do. A lot of it is time sensitive, but sometimes it's a long play also.
Gotcha.
So my advice is don't sit around and wait thinking that you got to get things in order before you talk to us. Go ahead and do that now. We can help you out, get you on a game plan.
That's really good. A lot of people don't know that.
Right.
They immediately start thinking, I got to call a credit repair company.
Exactly. Exactly.
Whereas they may spend, a couple $1,000 or sometimes even more.
Right.
Where they may not need to, is what you're saying.
Yeah, a lot of times they don't have to. There are cases, obviously, where they do need to kind of go that route. And we partner with different, credit repair companies, but we can refer those out.
Just tell me about what is down payment assistance and how does that apply?
So down payment assistance, those are different programs we have to definitely help with that out-of-pocket expense. That kind of ties back into what we were talking about as far as, how much money do I have to have out of pocket, right? So there's different programs that are tied into each one of these loans where we can give 3, 4, 5% of that loan amount back to assistance. We do that quite a bit. That's very common, especially with first-time home buyers, right? That's just trying to, they don't have that house to sell that's been building equity for the last, 5 years, 10 years, whatever, right? So those are things like if they're looking at a home for $300,000, we're looking at giving back up to is over between $12,000 and $15,000 to help with that closing cost. So a lot of times it'll cover that full down payment.
Wow.
Combined with some of those seller credits. Those are ways we get them in without, anything down.
That is incredible. Yeah. I'm sure a lot of people don't even know about that.
Yeah, and those are state specific, so state sponsored programs. So, they this is the interest rate, this is what you get. It's not something that, we have say over. So it just goes directly through those programs. And there's a few different ones that we use for this.
That's cool.
Yeah.
So as a first-time home buyer, what are some of the things that I need to be looking into? We did talk about credit a little bit, but so give me a list, like 5 top things.
And the first thing is really, what you spend, right? Saving, making sure that you're not going out and buying, running your credit for, buying that new car, or, hey, we're thinking about doing buying a new home. So now we're running our credit and looking at, furniture and appliances and kind of, putting the cart before the horse, so to speak. So, just watching your credit, not making, runs on that. And again, just getting with us so we can kind of coach you through, because, it's specific to the actual customer, what their credit already looks like, right? Of how we kind of get that there. For instance, we're doing one, a loan that we did last year. This lady that, had recently lost her husband, right? So now she's on her own and she's needing to, purchase the home, and didn't have the credit, didn't have the funds. And we worked with her, for 6 to 7 months to get that credit up to where it needed to be. Once we get it there, she ended up missing a small, like a $25 payment on a card, like a JCPenney's card or something. So, within a month, we were able to get that score right back up to where it needed to be and get her closed out. So just, one of those things that we just work with them. And again, go back to that game plan of, because each one is, very different.
I have here on the list new construction versus an existing home.
Yeah.
Right. So just tell me about new construction. My son actually just bought a house, brand new house out in Forney.
Yeah.
So how is new construction different than buying an existing home?
Yeah. So new construction is and kind of split into 2 parts. So you're going to have new construction, whereas maybe it's a builder building a lot of spec homes. So you'll see, a lot of these builders building, neighborhoods. And so that's not going to be different in the fact that, you're disqualifying to do it as a purchase. And once the house is finished, there's a few little hoops that you jump through, but, that's very easy. It's just like a purchase loan. The new construction that we do a lot of is working with our builders doing custom homes. And especially out here, in this area, that's what we're seeing. We're seeing a lot of custom homes. People on 2-acre tracts, 5-acre tracts,
right,
building their homes. So that's something that we have a lot of experience doing. We've done that for years. Work with a lot of local builders, and where you take out maybe your interim construction loan, get the house built, and come back in and put it in your permanent financing. So that's more of a long play. You're looking at the, building the home, taking it 7, 8 months, however long that takes, and setting up at the end. That's something we're definitely very experienced in, and working with our local builders.
Gotcha.
Yeah.
Like explaining to the homeowner, about draws and things like that for the contractors.
Yeah, and a lot of times that's going to take, a little bit more money out of pocket. Those down payment assistance programs, then they don't apply to those. Kind of building a home is, it's more of a privilege, right? Of actually building your custom home rather than just buying a home. So there's not so many of those programs out there to help you, get those funds to help out. So we have a setup where we can do it, 10% down is usually where we're at, which, what we're doing, there's a lot of banks that won't go down to that, 10%, a lot require, 20% down or 15% down. And, our interest rates are really good on those new construction homes. So, like I said, we've been doing those for a long time. And, out here in this area, there's, a lot of new construction going on, especially all down the, different county roads and stuff as these different, neighborhoods are kind of popping up with people building on these smaller tracts.
Right. Because you'll have people that'll just be looking for property, and then they'll say, "Hey, let's build a home there."
Right. So that starts off a lot of land loan.
Right.
Stuff. So hey, we're gonna go buy our tract right now. Pay on it for, so long. Then when we sell our house, we're gonna move out here and
gotcha.
build a home. So yeah, we see a lot of that.
Tell me about Reno loans.
Yeah. So a Reno loan, it kind of ties back into the construction, right? It's a renovation loan. So we'll see that. So if you're looking at buying that home that technically doesn't qualify for, let's say you're a first-time home buyer, right, and looking to buy a home that needs some improvements done on it. Well, FHA or all the government loans are very strict on the condition of the property. So if it doesn't pass that appraisal, there's nothing to do about it. But if you come in and say, hey, we're going to do, so much renovation work on it, we can roll that in to the cost of that loan. So basically we can say you're buying a home for, $200,000, you're wanting to put $50,000 in to, in improvements. We can use that as basically that purchase price and loan off the loan to value of that finished, subject to completion price. So that helps you with those, with the cost of those repairs.
Can you tell me a little bit about cashing out using your equity of your existing home? That's, we see people doing that all the time, right?
Right. So at Texas, cash out refinance. So Texas is very strict on protecting, people's equity, protecting their homestead. So, there are a lot of factors there. We can only go up to a loan to value of 80%, but we are still seeing that even with the higher interest rates, we're still seeing a lot of people doing cash outs because,
what is a cash out?
Yeah. So where they take cash out of their home to where maybe they just need cash, maybe they want to take cash out of that home using their equity of their home, right? So over the last, so many years, especially as we've had home values increasing at, 15, 20, 25% every year. People, if you've been in a home for 5 years, you're going to have quite a bit of equity in the home. So you're just tapping into that, pulling out that equity to do things like maybe you don't have the down payment for the new home, so you're pulling that equity out to put the down payment on the new home. And maybe you keep that home as a rental property.
Gotcha.
Maybe rolling those credit cards in that you're paying 26% interest on. Maybe the interest rate's a little higher. Maybe you're in the 6% interest range, but you're not paying the 26% on those credit cards. Helps you get out credit card debt and lower those monthly payments. So we're still doing a lot of those.
I see. That's really good. Mm-hmm. So the benefit is, you're basically taking advantage of a better interest rate and you're using your equity to do that.
Correct. Yeah.
Gotcha.
Absolutely.
Okay. So tell me, so people, they'll get approved and they want to buy their home and now they're like, what do I do next?
Right. Okay. So a lot of people, so you get approved and you go, you're shopping for that home, you find the home. Well, in the meantime, one of the biggest things that we see is people want to start going out and, like I mentioned earlier, shopping for that furniture, shopping for that appliance. They're running credit, or have people go ahead and start buying things after we've already approved them. So one of the biggest pieces of advice is once you get approved, right, don't do anything right with your credit. Don't go buy anything. Don't spend anything. I've heard it said like, whatever other loan officers, he tells his people is when you get approved, right, the only thing you can now buy is food and water. That's it.
Nice.
Not bread, water, nothing else. So it's just making sure to protect that credit. So, but then on that, finding the home, getting with your realtor, doing that, we get a contract. And from that point, we're off and running. We're ordering title work. We're ordering appraisal, putting it through underwriting. We have a team of processors and underwriters that are, we get these things pushed through quickly to make sure you have all your ducks in a row, to make sure it's a clean file. And we're closing loans, 2 weeks or less right now.
Wow, that's great. Okay, so tell me about the process. You are
So I'm a branch manager, right? So mortgage loan officer. So really what I'm going to do and our team will do is when we take it, like if you come to us, you're going to fill out an application and you're going to send us documents. We'll send you a link to upload documents. Those may be your W-2s and pay stubs and, bank statements, all the fun stuff, right? Again, we're going to turn those within 24 hours, a lot of times same day. And then at that point, we're giving you an actual pre-approval. You're taking that pre-approval letter to your realtor. So you always want to make sure you have that pre-qualification plus pre-approval before you go looking for a home, because those realtors are want to see that, because that gives them, they know that you've already talked to the lender, you're approved, and they're not wasting their time showing you the home. So you got to have that. And then all you do is find the home. We come back to us. We get a contract. Like I said, we're off and running at that point.
Nice. Okay, that's really cool. So is there anything else that, anything I haven't asked you that you think might be a benefit?
No, I think that's that kind of covers it. That's again, some of the biggest questions is, should I buy right now, right? Once you get past that, then it's, okay, how do I get pre-approved? How do I get pre-qualified? Then after that, it's just, off and getting the home. And then we take good care of our customers, right? We make sure that we're very hands-on. making sure that we go through that process. The communication is great. We firmly believe in, constant communication so you know where you're at. And so, no surprises. And again, we look to get everything cleared to close, because that's that's what everybody's shooting for. That's the biggest part. That's one of the best words right in our business, is that clear to close. Right? For us and realtors, getting to that closing table. So, and getting there as quickly as possible and as painless as possible.
What about gift for a down payment?
Yeah, good question. Yep.
And the reason I asked that question is I ran into something where I had, I don't know how much I had. I had enough money for a down payment for one of my kids, but I had it in one bank account. So I transferred it to another bank account so that I could easily transfer it to them.
Yeah.
And that became really difficult because I had to prove where it came from me.
Right.
So what's the best process for gifting for down payments?
Yeah. So first of all, gift funds, it could be given, like if it's family member or someone close to you, can't just be given to you from anyone. There's specific guidelines around those. But yeah, once you give those gift funds, everything you do, like your bank statements, all the funds, like large deposits, right? We have to source where that money comes from. So I think you talked about your son, maybe a VA loan or something. So if you do that, a government loan, you have to source even where those funds are coming from the donor.
Sure.
So then they're probably asking you for bank statements. And when you start moving funds, and you have to source, the bank statement that it was in before and so forth. So those are government loans. On a conventional loan, we don't have to source the funds where those came from. What we do, we have those funds sent directly to the title company. And so those are the proof of those gift funds. So we never have to go back and get bank statements from the actual donor.
Gotcha. That's good to know.
Yeah.
Very cool.
Yeah. So a lot of guidelines around those gift funds and around funds, period. So the main thing is, don't just jump off and start transferring funds, right? Don't just have mom and dad write you a check or give you that cash or whatever to put into your bank account, because we have to source all of those funds. So the main thing is, we get a game plan, we get you approved, we show what all that is before we move any funds at all. We can just put it in there showing those funds will be coming. And then at the right time, we will step you through that process of exactly whether we want it transferred into your bank account or whether we want those wired directly to the title company.
So tell me how you got into the lending industry. You didn't just come out of high school and say, I'm going to be a lender.
No, I don't think anybody just says, hey, I want to be in the mortgage business, or, hey, I want to be a realtor or whatever. But yeah, so I actually started off, when I got to college, I was a teacher and coach.
Great.
That's what I always wanted to do. So as a teacher and coach, I taught and coached at Southlake is where I started. Then eventually it's just one of those things, you're working a ton of hours, I'm making a lot of money. It's like, what can I do to just make more money, right? So I ended up in insurance. Well, insurance led me to mortgage. So it was one of those things that I just fell into, and I actually got into it. So I've been doing this for 15 years now.
Right.
And in 2008, when the market crashed, right, a lot of people were getting out. That's when I came into the mortgage industry.
Nice.
Because it was just one of those times where refis were going crazy, interest rates dropping, kind of where we are right now, right? From the 6s down to the 4s and into the 3s.
Sure.
So a lot of refinances. So that's kind of how I fell into it, and been doing it ever since.
Awesome, Tim. This has been really cool. I think we got a ton of information.